tariffs as the trade war between the world's two biggest economies, it escalates further. You can see futures are lower. Buckle up. It's Friday, April the 11th, 2025, and this is Worldwide Exchange right here on CNBC. Good morning. Welcome to Worldwide Exchange. Thanks so much for being here with us. I am Frank Holland. We're going to take a quick look at U.S. stock futures right now. Taking a look, you see we're in the red across the board right now. Looks like the Dow would open up more than 250 points lower. The S&P and the NASDAQ both down more than 0.5%. A really big change in futures from earlier, moving from positive to negative. Now we want to get to this morning's breaking news. China upping the ante against President Trump's tariffs. It's a story we're going to be talking about all morning long, the implications for the U.S. equity markets, the bond markets, and even the commodity markets, things like gold. With that, we're going to go to our Eunice Yoon live in Beijing. Eunice, good morning.
Hey, Frank. Well, China has decided to up the ante, raising the additional tariff to match President Trump's 145% tariff. So it's raising this additional tariff on all American goods that come here from 84% to 125%. Again, this would cover all American goods, and it would start on April 12th. Now, the other interesting part of this announcement is this sentence. Given that at the current tariff level, there's no market acceptance of U.S. imports, if the U.S. continues to impose tariffs on Chinese exports, China will ignore it. In other words, they're saying that they don't believe that Chinese people will actually buy American goods because they would be so expensive with these additional tariffs. So they said that if President Trump does continue to impose tariffs, then China is just going to ignore that. In fact, the Commerce Ministry also echoed that, saying today that China will ignore President Trump's, quote, numbers game. Now, while all of this is going on, China's President Xi Jinping has been courting all different sorts of countries. Today, he met with the Spanish Prime Minister, and he actually invited the EU through the Spanish Prime Minister to help China resist what he described as a unilateral bullying. In addition to that, we've been hearing more reports that the EU is going to be sending leaders here to plan a summit with Beijing, potentially in July. Now, in addition to that, President Xi is also looking towards Southeast Asia. In fact, the government here announced that President Xi is going to visit Cambodia, Malaysia, as well as Vietnam. Frank?
So, Eunice, again, we're following this breaking news. China raising its tariffs on all U.S. goods up to 125% starting on April the 2nd for people that are just catching up. I want to ask you, so the Chinese government, they talked about American goods, but what about American financial products? Is there the potential for this to escalate, to go from a trade war to, for lack of a better way to say it, a financial war? Yesterday, we had the 30-year bond auction. Demand was strong, but there were a lot of concerns that foreign buyers were pulled back. Also, some new information from Bank of America this morning that foreign investors, they dumped about $6.5 billion worth of U.S. equities in the 5 trading sessions ending on Wednesday.
Yeah, well, we haven't so far heard of the Chinese deciding to make any moves within the financial markets to potentially dump U.S. treasuries or do anything else like that. At the same time, there has been hints that China is willing to take some action against the services trade. So we're very closely watching that. And of course, that would include financial services.
Yeah, absolutely. Our Eunice Yoon live in Beijing. Eunice, please let us know if any other developments come up. Great reporting as always, and good to see you. All right, we're going to turn to the markets right now. We're going to start off with the currency markets right now. We're seeing an immediate reaction in the dollar yuan. Take a look right now. We were talking about this earlier this week, that the dollar has raised to its highest level against the yuan since about 2007 earlier this week. Right now, we're taking a look. You can see the dollar weakening against the yuan following this news. We had Rebecca Patterson, formerly of Bridgewater, on our air yesterday saying generally the dollar strengthens during a trade war. So this kind of counterintuitive for many investors, but again, the dollar weakening against the yuan against this news, still dollar up about 50 or 0.5% against the yuan this week. We also want to take a look at treasuries. The treasury market has become more and more important, seen by many, even the president, as one reason to pause his tariffs on many other countries. Right now, taking a look, the benchmark sitting at 4.40. That yield has risen about 40 basis points over the last week. Again, we had an auction of the 30-year treasury yesterday. Demand was said to be strong. The 30-year, the long bond, still pretty close to 5%. It almost touched 5% earlier, right now at 4.85. And we want to take a look at the VIX. Again, the fear and anxiety gauge of Wall Street right now. You can see it's at 44. It peaked even higher yesterday. You see it up higher yesterday, but still elevated historically right now. The VIX sitting at 44. And we want to turn our attention back to U.S. stock futures in the red across the board. As we mentioned earlier, they were positive earlier in the morning. Now in the red across the board, it looks like the Dow would open up more than 200 points lower. Let's now see how Europe is reacting to this news. Our Juliana Tattlebaum has the trade in London. Juliana, good morning.
Hey, Frank, good morning. Well, it's been a similar story here to what you just described in U.S. futures. We started out the session on the front foot after what's been an incredibly volatile week for European equities. But since that news from China came out about an hour ago, we have taken a turn for the worse. And now every region in Europe is trading lower. The Xetra DAX now off 1.7%. The CAC 40 off more than 1%. FTSE MIB off more than 1.5%. And the FTSE 100 faring a little bit better, but still down as well. From a sector perspective, we are seeing investors flee the riskier part of equity markets, so selling those cyclical stocks. You've got industrials, travel and leisure, financial services, the worst hit. Industrials down 2.7%. On the flip side, we are seeing more favor for those defensive parts of the market. Clearly, this is a risk-off trade this morning. You've got utilities in the green still up 0.5%. Food and bev and healthcare were trading higher, but even those two sectors are in the red now in the wake of this escalation from China. For the week overall, I think worth just taking a second to look at where we've traveled. For the week right now, the Xetra DAX down 2.2%, the CAC 40 down more than 3%. So we had a temporary sigh of relief on the back of that major announcement from the president midweek, rolling back the tariffs for 90 days at least. But that relief has proven short-lived over here in Europe, Frank.
Yeah, certainly. Juliana, you were wearing a lot of green this week. It seems like you have the right color on today. Our Juliana Tattlebaum, live in London. Good to see you. All right, joining me now is Philip Strail, Chief Investment Officer for the Americas at Morningstar Wealth. Phil, good morning. Good to see you.
Good morning, Frank.
All right, so we mentioned a considerable change of sentiment. We're looking at the futures market. It was higher earlier, now in the red. I want to ask you, what does this mean? 125% tariffs on U.S. goods after the U.S. Bumped up its tariffs on Chinese goods yesterday. What does this all mean for the equity market as investors are really trying to digest this trade war?
Yeah, great question, Frank. And, I think it's just a continuation of the escalation in the trade war between China and the U.S. I think we have seen that tit-for-tat behavior in recent days. And in some ways, it was not surprising that China was going to come back and basically match that the rate that the U.S. had put on or move in that same direction.
Wait, Phil, let me interrupt you. Not surprising. I think it seems like investors are surprised. Aren't you a bit surprised? I mean, this continual, what seems like an escalation and a tit for tat, that's not surprising at all?
I'd say the communication from Chinese officials was that they were not going to back down. And we know that, once that sort of, one country increases tariffs, the other one will kind of retaliate. And I think we've seen that behavior. I think the good news in the announcement today was that they said that we're not going to, continue that pattern. And if you look at the magnitude of where tariffs are now, both in terms of what the U.S. has on in terms of tariffs as well as China, it comes close to sort of almost an embargo, on both sides. And so, hopefully, that will make it more likely that, ultimately cooler heads will prevail and perhaps there was going to be some negotiation down the line. All
right, so your embargo comments, they really mirror some of the comments from our Jim Cramer as well. I want to ask you about the bond market. We've seen the bond market get very active, the so-called bond vigilantes. The president seems to be paying attention to that market. His cabinet seems to be paying attention to that market. As I mentioned earlier, bond yields have sharply moved higher over the last week. Are you expecting to see a reaction from the bond market? And then again, how does that impact the equity market?
Look, it's been one of the areas of concern, as you mentioned, this week. I think the bond market not acting defensively in significant moves we've seen on Tuesday and Wednesday in particular. So I think it's going to be a focus. And my expectation would be that, hopefully we found some sort of equilibrium, but it's certainly been unsettling investors, the fact that long-term treasury bonds as well as the dollar hasn't acted more defensively. in recent days here.
All right, let me talk to you about a very influential part of the market. Of course, that's mega cap tech. Dan Ives from Wedbush out with a note a short time ago saying, in part, it was a pretty lengthy note with the 145% tariffs now in place. The self-inflicted uncertainty from the China tariffs has turned the corporate capital expenditure world upside down. Do you agree with that take? The idea of capex spending for mega cap tech pulling back, a lot of people think that could actually lead to a significant decline in the equities and unwind that whole trade. Do you agree with Dan Ives' take here?
I think it's early to tell. We have seen significant capex by many of the Max 7 stocks, the kind of AI trade that was really the focus over the past couple of years. So I think it's too early to tell, but I'm sympathetic to the view that if you kind of look at the companies that have been doing the capex, whether it's the Amazons, the Apples, the Googles, these are cyclical businesses, and so if there is a downturn in the economy, I think you can see a knock-on effect. So it's, I think, too soon to tell, but it's certainly an area to watch.
You know, Phil, it's hard to imagine we haven't really talked about the president yet so far in this conversation. I want to play a soundbite from the president yesterday and get your take. Also want to hear what you think, how you think investors are going to digest this.
There'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing.
So, Phil, transition. That seems to be the word from the president right there. What's your take on that? How do you think the equity market and investors there digest this?
Look, any sort of clarity that the president can provide in terms of, what the end goal is and what that sort of transition looks like, I think will be welcome. And I think we've made a step in the right direction in terms of, the president acknowledging, the impact that the uncertainty had on financial markets earlier in the week, and there was a willingness to kind of pull back. But it's not clear what that transition looks like, and is 10% sort of the floor for all countries? Are there going to be more tariffs in 90 days on top of the 10%? And so I think if there's one lesson I think from recent days is that the financial markets need more clarity, need better forward guidance to be able to digest the trade policy that has been the focus here in recent weeks.
Yeah, we're seeing that digestion happen in real time, pulling back just a bit from their lows right now, but still in the red, the futures. Philip Strel, great to see you. Thank you very much.
Thanks, Frank.
And this morning, we're tracking ETF flows. ETF net inflows topping $338 billion year to date. We're also tracking the moves above and below the 30-day moving averages for the popular index funds, the SPY and the triple Qs. You can see here huge spikes earlier this week as investors look for ways to play the sell-off. Bond ETFs, they saw net outflows this week, but two bond ETFs were among the highest inflows, both the IEF and the SPTI. They track bonds in the middle of the curve. Northern Trust also says it saw rising inflows in the QLV, low volatility ETF.
You'll outperform on the downside. You'll perform competitively when markets are flat to sort of up small. And then on the upside, you're going to underperform a little bit. And I think about that as payment for that protection on the downside, very similar to the way you might think of like the way a buffer ETF works, but without the complicated derivatives exposure.
The QLV underperformed the S&P on this very volatile week, but if you look at a longer horizon, it is lower year to date, but those losses, they're just about half of the S&P 500. We have a lot more to come here on Worldwide Exchange, including big banks kicking off a critical earnings season ahead.